Mortgage rates just hit the lowest levels in a month, giving buyers and refinancers a much needed breather. But the critical report like the ISM Services Index and the US employment report on deck this week could now be the best chance to secure a great rate, or should you wait for what's coming later this week? Last week's housing data painted a mixed picture with cooling prices but declining new home sales. And while inflation remains stubborn, we have seen glimmers of stability in the market. So, what does this all mean for you? Stick around to learn how this week's economic data could shape your mortgage strategy, whether you're locking in now or waiting for potential dips. Let's dive right in. This past week brought a range of economic data showcasing a mix of resilience and challenges, especially in the housing market. Let's break it all down day by day to see how it all impacted mortgage rates. Monday was quiet on the economic front with no major data releases. Mortgage rates, however, dropped noticeably to 6.93%, down 10 basis points from Friday's close of 7.03%, offering a small reprieve for borrowers after weeks of elevated rates. Tuesday started with the S&P Case-Shiller Home Price Index for September, with home prices rising 4.6% year over year, down from 5.2% in August and below the forecast of 4.8%. This cooling trend reflects the affordability challenges many buyers face as rates remain high. Later that morning, the Consumer Confidence Index for November came in at 111.7, beating the forecast of 111 and last month's 108.7. This boost in optimism suggests that consumers remain resilient, which could support housing demand in coming months. However, the new home sales report told a very different story. Sales dropped sharply to 610,000, far below the forecast of 725,000 and last month's 738,000. This significant decline highlights affordability issues constraining the housing market. Despite the mixed data, mortgage rates edged up slightly to 6.95%, a 2 basis point increase from Monday. Wednesday brought a packed schedule for critical economic data, starting with labor market. Initial jobless claims remained low at 213,000, unchanged from the previous week and below the forecast of 215,000. This continued strength in employment supports the broader economy but also sustains upward pressure on rates. Inflation data from the core PCE index, the Fed's preferred measure, showed prices rising 0.3% month over month and 2.8% year over year, matching expectations. Persistent inflation remains a key factor in elevated rates. And lastly, housing data wrapped up the day with pending home sales for October, which rose 2%, slightly beating the forecast of 1.8%. While this was a positive sign, it marked a slowdown compared to September's 7.4% growth, reflecting challenges buyers face in the current market. Despite these events, mortgage rates dipped to 6.92%, down 3 basis points from Tuesday, continuing their gradual decline. While markets were quieter due to the Thanksgiving holiday, mortgage rates ended the week on a positive note, dropping down to 6.88%, the lowest level since early November. The 4 basis points decline marked a significant shift after weeks of elevated rates, giving buyers and refinancers a brief window of relief. Last week's data painted a picture of a steady consumer confidence, persistent inflation, and continued challenges in the housing market. While mortgage rates showed some improvement, finishing the week at 6.88%, the broader trend suggests that significant downward movement is unlikely in the near term. This week brings several critical data releases that could shape mortgage rates as we move deeper into December. So, let's break down what's coming and what to watch. On Monday, we'll get the ISM Manufacturing Index for November, a key indicator of activity in the manufacturing sector. Last month's reading came in at 46.5%, signaling contraction, and market will be watching to see if it continues to struggle. A weaker than expected reading could reinforce concerns about slowing economic growth, which might ease pressure on mortgage rates. Wednesday is packed with data, starting with the ADP employment report for November, which is expected to show 233,000 new private sector jobs. A strong report could underscore labor market resilience, potentially keeping upward pressure on rates. Later in the morning, we'll see the ISM Services Index forecasted at 56%, which reflects the health of services sector, a major driver of the US economy. If the index comes in higher than expected, it could indicate continued demand, which might push rates higher. Finally, the Fed Beige Book will be released in the afternoon, offering a quantitative view of economic activity across the country. Markets will look for a sign of cooling demand or labor market tightness, both of which could influence rate trends. Friday wraps up the week with the most significant data, the US employment report for November. This report will include non-farm payrolls expected to show just 12,000 jobs added and the unemployment rate, which is forecasted to hold steady at 4.1%. The labor market has been a key driver of the Fed's policy decisions, and any surprises here, especially in unemployment or wage growth, could sway rate expectations. Alongside this, the Consumer Sentiment Index for December will provide insights into how confident Americans feel heading into the holiday season. A strong reading could suggest sustained consumer spending, putting upward pressure on rates. This week's focus will be on the labor market strength and the health of the key economic sectors like manufacturing and services. Watch for Friday's employment report and Wednesday's ISM Services Index as the most critical drivers of mortgage rates. With mortgage rates at their lowest levels in a month, this week presents a real opportunity for buyers and refinancers who have been waiting for a better deal. The average 30-year fixed rate dipped below 6.9% last week, providing some much needed relief after weeks of volatility. So, if you're in the final stages of buying or refinancing, locking in your rate now could protect you from any surprises in the market. However, if your timeline allows, there are some key economic events this week that could push rates even lower. For those nearing the end of their loan process, locking in your rate this week makes sense. Rates are the best they have been in a month, and with the unemployment report and ISM Services Index, any stronger than expected data could send rates higher quickly. So, if you have some flexibility, waiting might pay off, especially if ISM Manufacturing Index on Monday or Friday's employment report signal further economic slowing. A weaker than expected report could create more downward pressure on rates. That said, this approach carries risk, as stronger data could push rates back up. Ultimately, the decision comes down to your situation. If you're ready to act, now's a great time to lock in a rate you're comfortable with. If you're willing to gamble a little, keep an eye on this week's data that could open the door for slightly lower rates ahead. This week is shaping up to be a pivotal week for mortgage rates. The key economic reports ahead and rates holding at their lowest points in a month, staying informed is far more important than ever. To help you stay ahead, I post daily rate updates from the top 5 banks, as you can see here. This gives you real-time insights into market trends, making it easier to track what's happening and feel confident about your mortgage decisions. Whether you're planning to lock in a rate or waiting for potential dips, aligning your strategy with your financial goals is the best way to navigate this market. If you found this video helpful, be sure to like, subscribe, and turn on notifications so you don't miss next week's updates. And if you need help navigating your mortgage, want me to review your loan estimate, or have questions about your rates, points, or fees, just drop me a comment below and I'm here to help you make the best decision for your financial future. Lastly, let me know in the comments, do you think mortgage rates will continue their downward trend, or are we in for another spike? Your insight could help others in the community. Thanks for watching, and I'll see you next time.